The unemployment rate in Australia is now rising. You'll see it go up in 2024, already has started. 2025 it will continue, maybe even 2026. So what should property investors or buyers be thinking about? Should we be buying now, or is this the start of an avalanche? With unemployment rising now, is this leading to something more catastrophic for property markets? Stick around, I'm going to take you through 4 to 5 charts that will completely crystallize your view and allow you to make clear and concise decisions. My name's Vic and I help people build passive income through Property Investment Accelerator using data without needing a $15,000 buyer's agent every single time. This channel, we talk property, economy, and financial happiness. Let's go. So you'll be seeing more and more and more of these types of news articles, this one from Channel 9, that have clickbait titles, quite frankly. Unemployment rate rises as 19,000 people go without work. As 2024 continues, you'll see this number go into the 20,000s, the 50,000s, maybe even higher into 2025. More than 100,000 people now unemployed. And this makes new people in the property market, either to buy or to invest, quiver. Let's understand the economic dynamic by zooming out a bit and seeing how unemployment cycles and property cycles really work. After every cycle during which interest rates have risen, it's completely normal for unemployment rate to start rising. And that is in fact, yes, when property markets start shallowing out. People think property markets fall when interest rates rise, but I've been going on about this for more than 2 or 3 years. They don't. Here's a chart from Longview, and on the left-hand side it says mortgage rate change over a period of time, and on the right-hand side it says house price index change over a period of time. And so these grays are house prices doubling 0 to 100% in different time periods, okay? 60 to 71, 71 to 76, then more recently 88 to 2001, 2001, 2010, 2010 to 2021. These are different time periods during which house prices doubled. And notice that only during 2 periods, 1988 to 2001 and 2010 to 2021, have interest rates actually fallen. The rest of the time, interest rates in these 4 examples have actually risen consistently during the same time period when house prices have doubled. So interest rates really have no correlation to house prices. When interest rates go up, house prices don't come down. And the same is the case in the US. So this is not like just a random Australian phenomenon. And you can see here, okay, the bars are the annualized return for house price growth, okay, and then this dot is how much or how many basis points interest rates or the federal funds rate rose. So you can see 78 to 80, house prices rose by 20%, whereas interest rates rose more than 1,200 basis points. And these so many examples, the averages, every time there's a quantitative tightening cycle, interest rates rise, house prices on average have risen by 12.5%. So you might be wondering, well, when interest rates rise, isn't that when the economy gets like weaker, it shrinks? That's the whole point. Well, it does, but there's a lagged effect. And when interest rates stop rising, that is really when the economy starts to shrink. That is when unemployment goes up. And that's why we're going to see an unemployment rate rise in Australia. And that rise has already started. This year, unemployment rate seasonally adjusted because, there's, summer, winter seasonal adjustments to be made from the ABS. And you can see here in 2020, it obviously spiked up because of COVID. And since then, it's come down. And then in the last year, 2023, late, it started to creep back up beyond almost full employment, which is categorized at or about 4%. So it's definitely on the rise, and I definitely think you'll be hearing so many media articles trying to warn you, trying to scare you about unemployment rising. But you shouldn't be scared, because check this out. This chart is so interesting from Macro Bond. What this is saying is the current unemployment rate of various countries compared to the long-term average. For example, let's take Australia. So the current unemployment rate, as we just saw, is just shy of 4%. And the long-term average in the red here is about 5.5%. Let's take the United States. Right now, the unemployment rate is around or just over 3%, according to this, and the long-term average is over 5%. So what we can see across these countries, the green dots, their current unemployment rates, are significantly, there hasn't been this much disparity from the long-term average, which is the red dots. Okay, see, the bigger the line, the bigger the disparity between current and long-term average. Why this is important is that even if the unemployment rate in Australia rises to beyond 2%, it rises by more than 1%, 2%, 2.5%, it is still in the general territory of long-term averages. Therefore, we're not going into a recession just because unemployment goes up to 5 or 6%. In fact, that's the long-term average. We're just going back to long-term averages. And always remember, when quantitative tightening occurs, interest rates rise, on average, most of the time, unemployment does rise by about 2 to 3% over the course of 1 to 3 years. So, if we right now were at the long-term average and then interest rates have gone up and now unemployment's going to rise by another 2 or 3%, that would be a need for worry. But we're so far below the long-term average that going back to averages is not really going to hurt the property market. In fact, Australia has been such an engine for soaking up and delivering employment to migrants that it has one of the healthiest economies according to this chart. What this is saying is that the dark blue, that is the natural increase in population in Australia. In other words, births minus deaths. Okay, so it kind of goes up and down, but it's kind of like around that sort of 100K, 150K positive every year. So more people are born slightly, 100K, then die. And the reason that population has really boomed in Australia is really around this 2005, 2006 mark where immigration policy was changed and this light blue line really spiked up to beyond 300 to beyond 400,000. And since then, minus the COVID time, we've kind of been averaging between 350 and 400,000. So Australia's population has been markedly increasing, and therefore property markets have benefited because of immigration, not because of natural increases, because of net overseas migration. And we know that that is continuing to deliver migrants into Australia at a rate beyond 350 or 400 per year for the foreseeable future. That's not the insightful part. That's not the interesting part. The interesting part is that actually these light blue immigrants, they've all been gainfully employed. This kind of immigration growth has been the highest in all of the OECD countries since 1982, except Israel. Okay, Australia at a rate of 1.4% growth is the highest population growth due to immigration than any other OECD countries since 1982, except Israel. And Israel has different social policies, I don't want to get into that, which make it a complete different story, different kettle of fish, different outlier altogether. So for all intents and purposes, Australia is the #1 immigration population growth country. And the main thing is all of those people have actually gained gainful employment. That is how strong of an engine the Australian economy is, mostly due to stuff we dig up from under the ground. Call it lucky, call it whatever you want, but that is what drives property prices. Thanks to Longview for these last two charts. They're absolutely brilliant. So this is a quick episode, but the moral of the story is, yes, unemployment will rise. Don't freak out. Unemployment goes through cycles, and it generally does rise after interest rate rise cycle, which we're about done with now anyway. The population growth of Australia is strong. It always has been strong, but those immigrants continue to have gainful employment. And as long as that's the case, the Australian property market will continue to deliver amazing results, because even though right now property should be falling, we're so far below long-term unemployment rate averages that going back to them, 2.5% increase in unemployment rate is just normal. Therefore, the housing market is not going to crash because of the lagged effects of quantitative tightening. A little bit of a complex topic today, guys, a little bit more advanced. I know not everyone will be interested in it, but if you really do want to make wealth, if you do really want to create a retirement catalyst for you and your family, you need to understand these things, okay? It's too important to just flick over, to level up and really take your knowledge to a sphere where basically no property professional in Australia is teaching you because they don't know, right? I'll leave links below to my podcast, Oz Property Mastery with PK, on Spotify, iTunes, and Google, and also the Facebook group with almost 50,000 amazing property members, Australian Property Mastery with PK. Free links below. Guys, hit the subscribe button, turn the notification bell on, give it a like. I'm so glad to be bringing you this type of content that may not get 100,000 views, but is more evidence-based and is more deductively logical than most things that you'll hear in marketing and sales world. See you later, guys. My name's PK.